Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Having recently given you an overview of some of the key trends on Wall Street, primarily at JP Morgan and Goldman Sachs because those are the two names that I hold, I thought I would take the opportunity to do something similar based on the latest tech results. In this case, the trio of Microsoft, Meta, and Alphabet, which owns Google, coming out on the same day was very helpful. Just to set the scene, the market has been running hot, as you are no doubt aware. On a year-to-date basis, Meta and Microsoft were each up around 28%. Alphabet, despite my overall bearishness around the risks to the internet economy that made Google famous, has been the best of the lot, with a 48% year-to-date move. Not bad when AI is causing lots of existential questions to be asked about the way the internet actually works. It just shows having an opinion that leads to staying out of a stock is way less dangerous than deciding to actively short it. Fascinatingly, Alphabet is also in the top spot over 5 years, up 248% coming into these earnings, versus Meta at around 186% and Microsoft at 162%. Perhaps it says something that I used Google Finance to check those numbers. Alphabet's relative dominance has been asserted in the market's response to these earnings, with Meta taking the nastiest knock in an after-hours drop of nearly 12%, so we may as well start there. 3.5 billion people use Meta's apps every single day, although the endless AI slop on Facebook might suggest otherwise. I'm not surprised at all to see that Instagram has a good news story to tell, with over 3 billion monthly active users enjoying an algorithm that tends to serve up good content these days. Video viewership on Instagram is up 30% versus last year. As for Threads, that's now up to 150 million daily active users. Despite Zuckerberg's assertions that it is on track to become a leader in its category, X's dominant position in that space does suggest otherwise. Now, if you're wondering why your social feeds across these apps have so much AI stuff these days, Zuck explains it rather well. He talks about the first era of social media where content from friends, family, and the accounts you actually follow dominated. The second era is the age of creator content, which is what we've been in until very recently. We are now in the AI era, where people can create and remix content, which is really just Zuckerberg putting a positive spin on the fact that socials now have even more fake profiles, nonsensical videos, and all kinds of things that further confuse the older members of your family who bravely created Facebook accounts and don't understand how much of what they are seeing is now just outright fake AI content. As you can tell, I'm not really a fan of where this is going, and I think engagement on social media is at risk of either suffering overall or just shifting towards users who are arguably less valuable to advertisers. Either way, they do need to be careful here with their core business. But of course, the apps are really just generating the cash that Zuckerberg needs for his pet project at the moment, AI. Meta is building on an open source basis and they are preparing for the future, and that means CapEx, of course. Zuckerberg refers to this strategy as one of, and I quote, aggressively front-loading capacity, as he isn't actually sure when we will achieve superintelligence, as he keeps talking about. The debate around whether we even want to achieve superintelligence won't be found here. There are other products that will come from this push, like the partnerships with Ray-Ban and Oakley, and again, it's pretty debatable whether we want to be in a world where people are walking around with AI-enabled glasses, but the global approach right now appears to be to see how the chips fall with AI, pun intended, and to then fix whatever is broken. Or not. Who knows really? Who knows what will break and what will get fixed? Let's get to the numbers, which is why I do still have a long position in Meta, and one that I'm still happy with because it has done very well. Family of apps revenue was up 26% year on year. The average price per ad was up 10%, so my concerns about the AI content aren't showing up yet. But total expenses were up 32% year on year, so one thing we cannot debate here, Zuck has opened the taps again. The last time he did this, the share price broke. I'm therefore not surprised that these numbers drove some pressure in the share price. But here's the comment that really spooked the market, and I quote, "Our current expectations is that our CapEx dollar growth will be notably larger in 2026 than in 2025. The market has seen this before and didn't like it. Hence the pressure on Meta's share price." We now move on to Microsoft. I've seen a lot of juicy terms emerge from the tech sector in recent times, but Satya Nadella talking about, and I quote again, planet-scale cloud and an AI factory surely takes the cake. He's not wrong, of course. Nadella has a history of great one-liners, like referring to Microsoft as the world's computer. Now, the incestuous web in the AI space continues, with Microsoft talking about having 10x'd their investment in OpenAI in terms of returns. As for exactly how they measure this, I'm really not 100% sure. Not only is there the equity stake to think about, but there's also the capital that has flowed back into Azure's services. When a company like Microsoft is trading on a huge revenue multiple, then in theory, if they buy stakes in companies and then watch that capital flow back to them in the form of revenue, that can do wonders for their market cap. Is it really creating value though? Or is it just kicking the can down the road? These are the big questions being asked in the market, with the word bubble coming up a lot from analysts, and analysts even asking the management team directly if there is a bubble. Needless to say, that gets a rather indirect response. Unlike in the dot-com bubble, when the companies involved were highly speculative and very light on substance, the tech giants like Microsoft are operating with the biggest corporate balance sheets in the world. They talk about doubling their data center footprint over the next 2 years at Microsoft. Yes, the music may stop at some point, but this band is still playing. And keeping them company is the 900 million monthly active users of their AI features. Revenue for the quarter at Microsoft was up 18% year on year, and operating income increased by 24%, so at least margins did go in the right direction. Operating expenses were up just 5%. Now, this is very different to the Zuck approach, but just be careful of the accounting here as you look at these things quarter on quarter and over time. Big capex today just means big depreciation later on, whereas spending on people on the R&D side hits the income statement immediately. So the timing of when it hits the income statement is arguably less important than the actual cash outflow each year. Still, Microsoft is in very good shape. Free cash flow was up 33% year on year. It's just an extraordinary growth rate for a company of this size. I still see Microsoft as the strongest, most resilient, most diversified way to play the big tech game, and it is therefore the largest individual position in my portfolio. Numbers like these show you why. We now reach Alphabet, which is the one that just keeps surprising me. They've just delivered their first ever $100 billion quarter in terms of revenue. They are trying very hard to convince the market that the AI era of search is not breaking their traditional web model, with their search allegedly sending even more clicks to websites. Now, let's just get serious here for a moment. Any website owner knows the truth, and so does any user of AI. It is very rare for users to actually click through to the links and check the underlying stats, because the AI is now giving you the answer, or at least giving you an answer, hallucinated or otherwise, and if people are using it correctly, they'll go check, but not everyone is doing that. It's funny how their network advertising revenue, the segment that measures the revenue they earn from Google ads clicked on other websites, is down 3%. So much for additional clicks and additional traffic going to websites. On the Google Cloud side, there's a lot of momentum, particularly in the enterprise level offering with deals over $1 billion. That is very much Microsoft's and Amazon's turf, so it's good news for Alphabet that they are gaining ground there. Products like Gemini Enterprise are taking the fight to Microsoft's Copilot. And this shows what Microsoft, Meta, and Alphabet all have in common. They already had tons of users out there and a natural audience for AI enhancements. But perhaps the most interesting story inside Alphabet is actually YouTube, which enjoys a greater share of living room viewing time than any other streamer. Yes, including Netflix. I really love the YouTube model, particularly the ongoing focus on user-generated content versus the AI slop being served up by Meta. YouTube is the widest moat business in Alphabet, in my opinion, and is now around 10% of their revenue. And that is just YouTube ads, not YouTube premium subscriptions, which are not disclosed separately as part of Alphabet's broader subscriptions business. Looking at the numbers, group revenue was up 16% year on year, and total operating expenses increased 28%. Operating income, that was up 9%, as operating margin came under pressure. But there's a big European Commission fine that is distorting the numbers here. If you take that out, operating income was up 22%, and thus the margins actually went the right way, more akin to Microsoft than Meta. The way the internet works is changing. I remain unconvinced that Alphabet will emerge with a moat that is anywhere near as powerful and wide as what they've historically enjoyed online. The market disagrees with me though, continuing to push the share price higher. Of these three names, my highest conviction remains Microsoft, and that is why it is my largest position. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.